exact same time. So
Fancy.
all right. Good morning, everybody. Jumping in. I've got Tracy Lasserre with Assurance Financial. She is the branch manager of Assurance Financial Group. And because the current rate climate has been hanging out where it's been hanging out over the last few months, particularly COVID related, we saw a lot of these rates get dropped down. The Feds have been buying this stuff down and are buying the rate down. And what's ultimately ended up affecting it was us mortgage folks, in the real estate world have been able to reap the benefits. So I wanted to go jump in. I'll first let Tracy take the floor. If you got anything you want to jump off and start chatting about, it'd be awesome.
Yeah. So basically, mid-March when the stay-at-home order started, there was a huge announcement that interest rates will be zero, and most people didn't know what that meant. So it set the mortgage world on fire, which is good because it got our phones ringing, it got the conversation started. But mortgage rates are not zero, nor will they ever be, hopefully. Basically, that was the bank buy rate. To be able to turn around and sell and make a profit. Story for another day because we could talk for hours about that. But rates are still really low. Rates have been low since March. Rates will be low for the foreseeable future. And it's been a very, very busy time for not only the mortgage world, but the real estate world in general, as a whole, because if rates are super low, more people can afford to buy the homes that they actually want. Maybe they've been on the fence waiting because they couldn't afford what they wanted, and now they can. As you know, Robbie, inventory's low because we have so many people not only buying but refinancing right now. Appraisers are busy, title attorneys are busy, insurance agents are busy, the national RD offices are busy. Everyone's busy, which is great. It's a great time to buy. It's a great time to refinance.
I'm going to kind of jump in. You talked about that too. One of the trends that's popping up, we see folks, I get a lot of buyers and sellers in particular wanting properties to close in 30 days. And I don't understand what's going on. I guess we talked about an analogy the other day. It's like we had 150 people come into our office at one time and they'd say, I want to close on, today's the 15th. I want to close on the 15th next month. And by the way, I want to be first in line for everything.
Everything. And I'm going to need to talk to you every day.
Yeah, every day.
Which is great, but it's impossible. So,
every single day.
Every single day. One of the analogies I gave a client, because it's so hard for someone who's not in the industry to wrap their head around what's going on right now. You're just pushing paper around. It shouldn't take that long, right? Well, imagine this. I have a client who is an OBGYN in the Houston area, and I helped her buy. Now I'm helping her refinance, and I just wanted her to know, hey, look, your refinance is going to probably take in the Houston area, especially, and I don't mean to talk about another market, but just to give you a big, broad picture of what's going on across the nation. That's my purpose behind that. I told her, I'm like, it's going to take you about 60 days to close on your refi. She's like, well, I already own the house. Like, we don't, we've done the title work a year ago. Well, the reason is because the analogy I gave her is, okay, you deliver babies, and let's say your hospital has 10 beds. So you can deliver 10 babies a day, let's just say. Well, it's not just the doctor who you need help with. You need an RN, you need an LPN, you need techs, you need all these people, you need food services, you need janitorial. And so let's say you have 10 hospital beds and you can accommodate 10 labors per day. Imagine 50 people walking in, ready to have a baby, all at the exact same time. There's not enough manpower. There's not enough hours in the day to deliver 50 babies all at the same time, right? So we're very lucky in this market because we have, especially at Acadiana, we have some incredible appraisers and title companies that work really, really fast for us, and they're very efficient. And our normal turn times without requesting a rush pre-COVID, pre-refi boom, was probably like 24 to 48 hours. Insane. Really good. We're so spoiled. Well, right now they're taking between 5 and 10 business days because they're busy, So the reason I brought up the Texas deal is because we think that's rough here. Texas appraisals are taking between 3 to 6 weeks.
Ooh. No complaints here.
The market's crazy, and it's good, but people can only work so fast. There's only so much time in the day. Your title companies too. So your title companies have to do a title, new title commitment on every single purchase refinance that will be financed. So your insurance agents have to rebind on a refinance. If a file's got to go to the RD office, the National Rural Development Office, for final approval on an RD file, they have to do that too. So, and then us, as a lender, and I left us out on purpose because most people are just, looking at the lender like, what's taking you so long? It's all of us, we're all busy. But you have a loan officer, and that loan officer probably has a processor who does all the ordering of services, verifications of income, employment, appraisal, title, insurance. But you also have an underwriter, you have a disclosure department, you have an audit department, you have a lock department, you have compliance, you have all these people who have to touch that one file, and it takes time, and eventually you may work really fast as a loan officer, but your stuff starts to bottleneck somewhere at some point.
Yep.
Because you can only work so much. But it's a great time. It's a great time to be in the business. It's a great time to buy a refinance. Don't get me wrong. I just like setting the tone in the beginning. I had a friend who sent me a contract yesterday, a realtor friend, and it was 28 days. And I emailed her and the buyer right away. And I said, hey, guys, I just want to let you know things haven't slowed down. Like 45 days is ideal. I'm so sorry. I work as fast as I can, but know that everybody's busy right now. And this probably won't close in 28 days. Our company is prioritizing purchase business because you have a deadline on a contract, right? You have sometimes multiple offers and contingencies where one file depends on another closing, and it's a domino effect. And you never want to be the one left holding the bag, not being able to make it work in time. So purchase business is a priority, but at the same time, we can't have a super short contract. If anything, let's try to do a 45-day contract. I know we talked about that with your team yesterday, Robbie. As long as you explain to people and you tell them the why behind it, I have yet to have anybody just not be okay with it. And most people know what's going on. You just do a good job of educating up front, setting expectations up front, and do the best you can, and typically everybody's happy in the end, because it's not anybody saying at the last minute, hey, oops, sorry, I know you want to close tomorrow, but we can't. Right. Nobody will do that.
No doubt. Now, one thing I wanted to jump in, I'm going to pivot real quick because there's a handful of things that have popped up when COVID got cranked up, that things got really squirrely. One of them was jumbo loans. So tell me a little bit about that. Some of them just weren't available at all. We had them. I think we had it for a little while with you guys for we had it for a while. We had one, you guys were able to make that happen for a little while, but sometimes it got kind of sketchy. Requirements got kind of crazy.
Right. So when COVID hit and the stay-at-home order hit, guidelines temporarily changed for lenders and for mortgages, because people were losing their jobs, people were getting furloughed, people were getting pay cuts, and that affects a mortgage, because if we hold the paper and that loan goes into forbearance or default, we still have to pay the backer of that loan that money every month. Not only the money, we have to pay the taxes and insurance on it too, which a lot of people don't realize. As a lender, as a servicer, you're responsible for paying your investors for all of that. But all that aside, a jumbo loan and our more risky products like conventional, we had hit the pause button for a bit. And it wasn't just an Assurance Financial thing. It was a national thing.
Yeah, that was financial too.
It was like the big banks that were the ones who were taking and either underwriting or servicing these loans after they closed. So think your big banks like your Chase, your Wells Fargo, your Bank of America, all those guys. They just said, hey, stop. We're not taking anymore right now. And jumbo loans are back. They look a little different right now. 20% down, even lower debt to income ratio standards, more reserves are required right now. And that's not forever, that's for right now, because there's still people getting pay cuts. There's still people getting furloughed and losing their jobs, unfortunately. So until we return to some sort of normalcy with all the phases and the stay-at-home orders and the COVID, and when businesses can hopefully return, that's just how those more risky products will be. Jumbo loans, that there hasn't been a big appetite for it still. So rates aren't what they used to be. So rates are just a little bit higher than what they were before.
I know. In jumbo, this is going to change like by the minute. But if the perfect scenario runs, where we're seeing rates south of 3, if the stars are aligning in credit and debt to income and all the other factors that are involved. And what are jumbo rates roughly running, give or take?
I would say that we've been seeing jumbo rates, and it's been a couple of weeks since I've checked, but I want to say like in the low 5s. Big difference. Where our jumbo rates used to be right in line with our conforming conventional rates. We on a good day have amazing jumbo rates. Like, makes you second guess yourself when you look at them. But again, there's just no appetite for that right now. Where you're seeing, if and when you see a low jumbo rate, it's probably an in-house portfolio product for a local bank. And what does that mean? That means that bank is taking that risk, like a local region. Keeping it in-house. The board is probably underwriting and approving it. And then they're just a local bank can borrow against their deposit holders and loan out money to nearly anybody they want who fits in their box.
Mm-hmm. Yeah. Gotcha. So another one I want to, and Guy, to answer your comment earlier, the reason for the slow or not being able to close in time, it's the expectations that were set up front of a 30-day close. It needs to be more like 45 to 60 in order to let everybody else that's involved in the transaction, the appraisers, the insurance agents, the title attorneys, the closing departments that are on top of the loan officers. There's literally hundreds and hundreds and hundreds of mortgages going on at the same time, and new ones every single day. So the next one I wanted to pivot on was self-employed homeowners. COVID threw a whole bunch of, between payment protection program and deferred loans and forbearance. And I mean, we've run into a couple of deals on in our pipeline in particular that have caught some snags. So I want to dive into that a little bit too.
Yeah. So if you're self-employed, again, that's a little more of a risky product for a mortgage company, for an investor. So what we need on self-employed borrowers is last 2 years tax returns, business and personal. So let's say 2018, 2019, and then a 2020 year-to-date profit and loss statement. It typically does not have to be audited by a CPA, which can be very timely and expensive, but it can be self-prepared by the business owner, the borrower, but also most recent bank statements for those businesses that we're using for income. And fortunately, we haven't run into any snags with that. I think, again, that goes up, talks about setting expectations up front. Any of my clients who are self-employed, I tell them right away, hey, you know how you normally just give me your tax returns? Well, now I need this, and everybody's been fine, because it's us telling them in the beginning and educating them on the why. And I haven't had anyone complain about it or be upset about it or not be able to provide it. I've closed a ton. It's the world we live in. It's crazy. We're all doing the best we can. But I have closed a ton of self-employed borrowers, new and past clients of mine, and I have a ton more in my pipeline. And fortunately, I don't foresee any issues with them. We are reviewing. The reason for the P&L and the 2020 information, excuse me, is because we need to make sure that business is still prospering,
viable.
Yeah, that it's still open
for funds due to a dip in ability to go and hire people. You were asking for because COVID killed your. That's what the disaster loan was for. So that's what they need to see, that you're going to be sustainable past 2 or 3 months for whatever's left in your savings account to be able to go and bridge the gap, and that you should be able to continue moving forward. So
exactly.
Cool. Let's see. Another one I wanted to jump in. So the headlines about low interest rates, how that really affects buyers. We kind of talked about, how the timeline and what that happens to look like. One other thing was what factors are going to determine how low that rate's going to be?
There are a lot of factors, and I think most people don't realize that. They're like, but I have an 812
credit score.
That's awesome. Good. That's one of like a dozen factors. So, okay, let me see if I can remember everything and not forget. Credit score is huge. So depending, what do you oh. So the higher the score, the better. End of it. But most programs have tiers, like 20-point tiers. So if you're a 7 to 720, you kind of fit in this little bracket. If you're a 720 to 740, you're here. You see where I'm going with that? Yep. Loan to value can sometimes be an issue.
What's that target?
30% is ideal.
And that's, break that down to the third grade level, because we got.
Okay, so if you buy $100,000 house and you have a $70,000 loan, that's probably a bad example because a low loan amount is also a trigger of.
Do 300.
Yeah, so 300,000, and you put 30% down of that, okay, and that will be your loan amount. So, the reason that is because you have skin in the game, and the investor likes skin in the game. So the more money you put down, typically the better. And it gets kind of confusing with PMI because PMI mitigates some of the risk on a loan. So if you have a conventional loan and you have PMI, let's say you have 10 to 15% with PMI, your rate's probably going to be better than if you have 20% without PMI, which sounds really crazy. But again, the PMI company backs and insures the loan against default, and it mitigates some of the risk for the investor. So sometimes you can see a change with that. Whether you escrow or not, lenders want you to escrow. So if you escrow, your rate's a little bit better. Your terms, the lower the terms.
Escrow too, for those that may be watching and don't know. Escrow, 1/12 of your property taxes goes into a savings account. 1/12 of your property insurance goes into savings account. The reason it's called, the savings account's called escrow. It's yours. It's your money. It's interest free. So at the end of the year in December, when property taxes are due, escrow pays it. At the maturity of your insurance policy, escrow pays it. So the one lien that can get in front of a first mortgage is property taxes, and they want the asset to be protected. Hence the property insurance, which they reward you for escrow, and a lot of these companies will do that. So
exactly, and for insurance, because we want the property to be insured 24/7, 365 days a year. Asset protection. Terms. The lower the terms, the better the rate. What's a term? 10-year, 15, 20, 25, 30. The longer the term, if you take out a 30-year mortgage, the rate will be higher than it is on a 10-year mortgage. Again, less risky. The mortgage is paid off faster, etc. Loan amount. The lower the loan amount, the higher the rate, which most people scratch their head about that. The reason is you have to think about the investor on the back end and the money they're making. So the investor on the back end, the lower the loan amount, the less amount of interest they make. So in order to back that paper, they want to ensure that they're making enough money to at least cover cost, if nothing else. So the higher the loan amount, typically the lower the rate. We said loan to value, so this is pretty much everything. Something else that's important, people like talking rate, and rates are important, but what a lot of people don't talk about is PMI. And the reason I like to talk about that is because you don't pay rate. You pay a payment. You make a monthly payment every month, and that's what dictates your affordability and what you buy, right? And most people don't realize that PMI can be manipulated in so many different ways, depending on the scenario. So when you're out shopping rates, And most people, they try to educate themselves before they start shopping mortgage companies, and they want to know what the rate is. Well, knowing the rate is great, but you need to ask so many more questions. You need to ask about the product and the program. You need to ask about the PMI, and you need to ask about the closing costs and the loan fees, because bank ABC down the street may quote you 2.5 today on a 30-year. But if they're charging you 1 to 2 points to do that, God, anybody could do that in their sleep, and you don't want to overpay for something that you could get, at a better term or deal somewhere else. So don't just educate yourselves on rate, educate yourselves on everything else that is involved in the money that's coming out of your pocket, whether it's upfront at closing or every month within that mortgage payment.
The moral of the story: don't look at the bottom right-hand corner of the fee sheet.
Yeah.
There's a little bit more attached to it than that.
A lot more. There's a lot more in there.
There's a reason that page is this long. Well,
yeah.
You're on the screen.
And sometimes 2 pages.
Real big. So one of the popular things that I've actually been hearing about buyers asking me too was buying down points right now. Is it a smart strategy? And we could probably talk a little bit about break-even rate on
yeah.
stuff too. So,
it can be smart. So whenever I price out a rate for someone when they're ready to lock it, I like to give options when possible. So let's say a par, which is a break-even rate. What is a par rate? That means, let's say the rate today, and again, I'm just using round numbers. It's not what the rate is today, but let's say the rate is 3% today on a 30-year fixed. And it doesn't cost anything, meaning it doesn't cost you as the buyer to get the rate. You don't have to pay a point or discount point or whatever, but also you're not getting what's called a rebate or a lender credit to help offset some of the out-of-pocket expense or closing costs at closing. Let's say 2.875 costs 1/8 of a point. So 2.875 would cost 0.125 of the loan amount. So you take the loan amount, let's say it's $100,000, it would cost you $125. Would I recommend someone doing that? It depends. My first question to the borrower is, how long do you think you're going to keep this house? Not how long are you going to own it or live in it, because that doesn't matter. What if you turn it into rental property later and you have this incredibly low rate? Well, yeah. If you tell me, oh, I'm going to keep this house for 10 years, I'm going to turn it into rental property, blah, 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 I'm going to do the calculation and tell you and figure out where the break-even point is, where the cost for that rate meets that monthly payment savings. And if it's in line with how long you think you plan on keeping that property, then I'll let you know, yeah, I would do this. On the flip side, if it's a $300,000 loan and it costs you a point to get down, if it costs you 1 percentage point of loan amount to get down by a quarter, I ask the same question. How long do you plan on keeping this house? If it makes sense, then yeah, you pay the quarter to get the lower rate and, you move on. But if it costs too much and if the difference between the rates is super high, and if you don't plan on keeping that house for long enough, then no, don't do it. It doesn't make sense.
So you never tell me to buy down my points ever.
What's that? No. No. Robbie's in a different house every 2 years. No, you cannot buy down.
Here's one day I'm out. See you later.
No, don't even ask.
I'm so twisted. I'm thinking about the one after the next one. So sickness. Now we flip on the opposite side. One of the other strategies that runs around is lender credit.
Lender credit can be so
from buying down to lender credit.
They're the opposite of each other. Exactly. So let's say I have a first-time home buyer or somebody who really maybe we just don't have enough assets to make the deal work. Then I will give the option of lender credit. So maybe they take a slightly higher interest rate and the points left over behind the rate, we can't keep. By law, CFPB came in and said, you cannot keep that anymore. So we have to give it back to the borrower.
Financial protection bureau, by the way, miss acronyms. So.
Google it. Nobody cares. So then you can turn around and give it to them in the form of what's called a lender credit. So same as a discount, only reverse. So let's say they have $100,000 loan, and the lender, the points behind the rate that's left over is half a point. Then you can give them $500 to help offset closing costs and their out-of-pocket expenses. And for some people, especially first-time home buyers, that's a lot of money, because if they've already paid a down payment and an inspection and closing cost, that little bit helps for sure. So that is always an option.
And shoot, for somebody like me that's there for 2 years and a day, sometimes it actually makes more sense to take a higher rate.
Right. Yeah, it's true. It's
gaming
true.
the system, y'all. So let's see. And we talked a little bit about break-even point, and I'll kind of tether back. So when would the best time to buy down lender credit
versus? It's not going to be the same for everybody. It's going to depend on how long they plan on keeping the house and the cost behind it. That's a case-by-case basis. I basically run through an amortization schedule on each file, and I just tell the clients, hey, based on what you've told me, what we've talked about, I wouldn't do this, and this is why. Or based on the conversation we've had and what you've told me, if it were me, I would do it, and this is why. So you can't really say, definitively without having a specific file to talk about. But it's good to ask about it. Yep. Just so just like shopping programs, like why would I go conventional instead of FHA? Great question. This is why. It's good to know, just to give you that peace of mind of knowing you did everything you could to get the deal that was right for you at the time.
All right. So now that we've talked about like lender credits and buy down rates and all that fun stuff, let's get into the meat, which everybody likes to talk about. That's the sexy term, is rates. So, this stuff is going to change by the minute for everybody that's out there. So, and all the scenarios, the 12 that we talked about a little bit, all have to align. So we're going to see some things up and down. What are you forecasting, at least for the next, typically speaking, we've been through a few of these elections, but normally things start to spike up a little bit post-election. What are you seeing? What are the powers that be kind of predicting over the next weeks?
Well, yeah, the powers that be, like the rate experts who forecast rates, they didn't expect COVID to happen this year, but they did say last year, and rates were low last year. We refinanced a lot of people last year, but you hate to predict the future too much and not help people immediately when they want help with a refinance. But last year, the experts were saying 2020, you will refinance the people who are buying from you right now. And that is exactly what we're doing. Now, again, they didn't anticipate COVID, but that's exactly what we're doing times 20, maybe times 30, I don't know. But typically with the election, like with the last election, rates spike up. We'll see what happens. We've got a couple months to go to see how the market reacts. It could go either way. The experts, given COVID, still going on and things still being in turmoil, they're saying that we may not have hit that pit rate yet, which is crazy. And look, to all my clients out there who refinanced already, so did I. I refinanced this year already, but you hate to take a gamble and not do it in case if and when rates do spike up, they don't stop, So yeah, look, if rates drop again next year, great for all of us, I guess. Bad for some, but great for some.
Well, this is about as free of money as we're ever going to be able to see, and such an awesome opportunity. I guess right now, what is a range for a 30 that you're seing?
A 30-year.
20%.
Oh, wait, hold on. You asked me a question early, and I just thought of something else. So you know how you mentioned things that affect interest rate? I'm going to use all kinds of acronyms again. So refinances now cost just a little bit more than a purchase. And the reason is, and people may not really notice it, but the reason is FHFA, basically think of the governing body of the conservatorship for Fannie and Freddie, and that still won't mean anything to anybody, but they're concerned about foreclosure and default and forbearance and everything else, that they hit a little price adjustment on refi files, conventional refi files, starting this past Monday.
For cash out or straight term?
Nope. All refinances on conventional.
So buy a house, y'all. That's really what we want to see.
Just buy a house. No, you can still refinance too, and it's still good.
Every other year, your realtor would thank you.
Yeah. Wait, what did you ask me first before I?
No, 30-year fixed rate. Give us a range.
Oh, okay. 30-year fixed rate. Let's say without buying points, your rates are still in the twos. I'll say that, mid to high twos, depending on the situation, which is insane. What was your rate when you bought your first house, Robin?
6.875. I feel like I'm my grandparents or my parents. 19%.
I know. We stood in line for 19% all day long. That's what you hear everybody say. Yeah. Our first rate when we bought our house was in the sixes.
I want to say it was 6.875 is what I did.
I was like around 6.5. Y'all, 6.5. If you told somebody their rate was 6.5 today, they wouldn't know what to do with themselves.
Oh yeah, they'd fall out of chair. So
yeah, rates are really good. Really good. You can buy a really nice house with a rate in the twos, even in the threes. That's half of what we.
That's 6.5%.
That Lori.
Yeah, Lori's checking me. 1885 for a $300,000 30-year 6.5%. So let's do 2.75 because you said mid to high twos.
So rates are half of what we paid when we bought our first house.
Yeah, that's more than half.
More than half.
Rate 12.22.
Everybody needs to call Robbie and buy a house. Buy an investment property. Investment property rates are really good too. Really good.
We are seeing an influx of that too. So into the rental market, getting some passive income, stuff like that. You're able to leverage equity from your home through a home equity line of credit, be able to jump in. It's been really fun. So I
have more and more clients who are calling me to say, hey, you know how you refinanced me earlier this year and rates keep dropping? Well, we've decided instead of selling that house, we found the perfect house. So we're going to keep this house and turn it into a rental, and we're going to buy another house since we can afford it now.
Yep. And the
crazy.
This is something that I've done on my Facebook videos too, talking about that rate. People have been able to, we've seen some of the upper end inventory that's been hanging out for so stinking long on the market is starting to drop.
Yeah.
The affordability of these houses. I mean, look, you just saw just a little while ago. Now, granted, that was when I bought my first house 15, 16 years ago. But right now, even 4.5%, that's like $1,500 a month without principal, without taxes and insurance. Anyway, long story long, people are able to jump up and afford more house, better house, they're getting more kids, a nicer amenities. They can jump and do that, or they can stay where they're at, and you either sell that and start working on the investment side of the world. We can help you with that too. So
yeah, it's a good time. It really is. I'd say it's a good time. It's a good time in this industry. It's a good time for homeowners. Overall, terrible time. 2020 is awful. But, you have to make the best of where you are. And if we can help people, I've had a lot of past clients call me, in situations where they needed to refinance. And it feels good to be able to, do your job and really help somebody when they need it.
Yep. Well, Tracy, it has been awesome having you on, and thanks for sharing your insight on all things mortgage. I know everybody's probably either dropping their kids off at school or getting into work, but I wanted to thank you for hopping on. It's been a little bit. Let's not wait so long.
Yeah, sounds good.
Y'all make a great day, gang. If y'all need anything, you can call Tracy on her cell, 337-257-9146. Myself, 337-658-5690. Hope everybody has a great day and an awesome week. Take care.
Thanks. Bye.